Hey everybody, Economic Ninja here. Now, wrong person, wrong channel. Real Estate Ninja here. Hope you're doing well. We're going to talk about a story out of the Daily Huddle. It's entitled JP Morgan Chase, Wells Fargo, and B of A, Bank of America, hit with negative ratings outlook as Moody's says the U.S. government now has weaker capacity to support big banks. This is getting really hot. I still cannot believe that an official recession has not been announced. I know they're building factories and they're sending money to Ukraine, so that makes it look like the GDP is getting big. But you got to admit, with this many layoffs happening, with so many credit rating agencies now out there warning people about the government and banks and all kinds of stuff, now they're hitting the banks saying, hey, the government won't even be able to backstop them this time. The government is hyperinflating the currency. The government is out of control spending. This is crazy to me. It says here, 3 U.S. banking giants have had their ratings downgraded to negative by Moody's. Moody's Investor Service downgraded JP Morgan Chase, Wells Fargo, and Bank of America to negative ratings after previously classifying them as stable. Market Watch analyst Peter Nearby of Moody's said that the worsening outlook on bank debt was due to potentially weaker capacity of the government of the United States of America to support the U.S.'s systemically important banks. In particular, JP Morgan's downgrade was partially because the bank runs a complex capital markets business that may pose substantial risks to creditors. A potential upgrade for JP Morgan would depend on sustaining strong and stable performance and capital levels above its competitors, Moody said. Despite the downgrade from Moody's, all 3 banks' stock prices are in the green for November so far. You know what's exciting? When I started the Economic Ninja channel 3.5 years ago, I said, I am going to walk you through what a collapse feels like, because so few people have any concept of what it is. They just think that things are good and then all of a sudden things are bad. But it's because of the way we recall things. I don't know if you know this, but science has proven that when we use our memories, we are recalling a point in life where we recalled a memory. It isn't us going back in time to that exact time of the memory that we're recalling. We're recalling a memory of a memory of a memory. It's just recalling those memories. And so people do not understand how crashes work. We're in a crash right now. That crash actually started in 2019. I know it sounds crazy, but the only reason it's gone on this long, much longer than the 2005 when mortgage-backed securities imploded, to 2008, which still didn't bring the housing bottom, to 2010, 2011, where the housing and stock market definitely found their bottom. People, and actually just so you know, the Dow found its bottom in 2009. But my point being is because it's all of these chains of events. And the reason why this one has taken so much longer is because the Fed jumped in and they had something to save them. I know it sounds crazy, but when everything shut down all over the world and they said you got to go home, that was their saving grace. It's almost like it was blown out of proportion for a reason. And that's why we can't talk about it. So now the banks are being downgraded. The government's being downgraded. And what's more important is that right now, China, Russia, India, the BRICS nations, they're all watching these news stories. So look, their credit rating agencies are even downgrading them. They're moving faster, the credit agencies, than they did in 2008. And for anyone to say, you're a doom and gloomer, you're an idiot. I don't know what to say. I just keep doing you. Like, enjoy life. Run into the wall. I'm not going to feel bad. What I do feel bad for are the good-hearted people in this world and in our country that don't see it. And that's who I'm trying to wake up, because they're like, oh, wait a minute. No, I think logically. I had my head down, to the grindstone trying to make a living. I didn't see all these warning signs. This is a big deal. Now it says here, in a research note released last quarter, Moody's said that the U.S. banks were facing significant risk of deposit flight due to interest rate and asset liability management risk. Here's another risk. Do you remember when I said there was this massive, withdrawal of the banks? It was a run on the banks happening from last November to the springtime, which completely led to the panic in the banking system in the spring. And that was because people were running to yield. They were moving their money out of specific accounts, checking, savings, things like that. They were moving it into money market accounts, right? There was a massive move. Now, with this recent stock market pump, I believe you're going to see massive inflows from I mean, look at it. Tech laid off a ton of people, went through a massive overhaul back in January. Now it's green. Oh my gosh, this is great. No, they're selling less stuff. People need to understand that they are selling less stuff than they were a couple of years ago. That's bad. But no, their earnings are different. Yeah, because they're selling less stuff, having to pay less people, and for right now, they're showing a little bit different margins. So what's going to happen is people are going to move from money markets and bonds into the stock market. They're going to push that one last pump. And this is the one I'm telling you to be wary of. Be very cautious. If you're trading the market, you're running off of fundamentals, be careful, because fundamentals, they're not what they're explaining. If you're doing technical analysis, you're looking at the charts and you're trading off of that 120-day moving average, okay, I get it. Your money's in, your money's out. You know, you have a calculated risk. But right now, all of the data shows we're in complete and utter crash mode. And the only thing keeping us on target is lifelines. Like we're hooked up to an EKG machine and the heart rate's doing this. The only thing keeping us going is the hope that there's going to be enough electricity pumped into that heart that it's going to keep moving. Now, Moody's, which controls 80% of the global ratings industry, along with Standard & Poor's, is forecasting a recession for the U.S. economy early next year. They say we continue to expect a mild recession in early 2024, and given the funding strains on the U.S. banking sector, and just, you know, the reason why they say mild, Moody's has gotten their hand slapped in the past by the government for coming out against them, and other credit agencies have too. And so what they do is they try not to spark fears. And so they say mild, and if they're wrong, like, well, we told you there's a recession coming. It's just, well, who's going to guess? But if they came out and said, we see a severe recession coming, they're going to get in trouble. They're going to get phone calls from three-letter agencies. And the other thing too, what people need to realize is they've already came out and now they've hit the government and the biggest banks with negative ratings. This is, they've already done their job. Anybody that doesn't pay attention to this is going to get a little nutty. Now, ironically, like it says, the stock price is up, but their borrowing costs are also going to go up too. So you have to realize that 3 months down the line, 6 months down the line, these facts are going to come out in bank earnings. So they're going to come out and say, our cost of borrowing went up. Thanks a lot, Moody's. Thanks a lot, S&P. And that's what's happening. And it says right here, you know, they expect a mild recession, and given the funding strains on the U.S. banking sector, there will be likely a tightening of credit conditions and rising loan losses for U.S. banks. That ties into housing. It's nuts. If you want the deal for the Black Friday deal, the how to prepare for the real estate crash course, it's down below. It's the Black Friday deal, and it's coupled with 2 other bonus courses. And I actually just got a text from someone. I can't show you the number, but I'm going to show you something. I'm going to tell you something, because he works for a few of the largest home sellers in the country. He said, is the Home Seller Pro course available as a standalone course? You really did a good job on this one. I got so many ideas from it. This is not only someone that works for the largest companies, home builders in the country, but he is an awesome real estate investor himself. So thank you so much for that comment. If you guys want it, it's $289 for all 3 of them. Get ready. Crashes take a long time. It's going to be a big deal. I'm excited. With that being said, the Real Estate Ninja is out.